In today's video, we're going to continue part of the Compounding Life series on personal finance, investing, and time value of money. Today, we're going to take a closer look at the differences between a 15-year, a 20-year, and a 30-year mortgage, walk through some assumptions with those respective loans, and then talk about the total amount paid, the extra amount paid. Extra paid is a percentage, and then the total amount of principal and interest paid over the first 10 years of those loans, respectively, in each of the three scenarios. So let's just begin with our assumptions. We have purchase price of $500,000, a down payment percentage of 25%, a down payment amount of $125,000, loan to value of 75%, a loan amount of $375,000, interest rate of 6%. The years are 15, 20, and 30. And then we have our payment amounts on a monthly basis right across here in each of the three scenarios. So as you can see in the example for the 15-year, the payment is higher than the 20 and the 30, and then the 20 is higher than the 30 simply because if we're going to pay a loan off in a shorter amount of time, the payment is going to be higher, obviously. So the 15-year has the highest payment, followed by the 20-year, and then the 30-year has the smallest monthly payment in this scenario. So what I want to draw your attention to is here at the bottom in each of these three scenarios, it's a total amount paid. So the way this is calculated is it takes a monthly payment times 12 for 12 months in a year, and then it times it by how many years the loan is. So in each of these scenarios, it's 15, 20, and 30 years for each of these three loans. So we have our total amount paid right here, just across like that. And then as far as the extra paid, the way that's calculated is total paid minus loan amount. You can see how that's calculated there if you click F2 on your keyboard. And that's just taking into consideration the loan amount, not the purchase price. So we're focusing on taking the loan out, how much extra is paid on top of the loan that is taken out. Now let's move down to the percentage extra paid. So the way this is calculated is basically taking the extra paid divided by the loan amount. And again, the extra paid is the total paid minus the loan amount. So the percentage extra paid is extra paid divided by the loan amount. So you can see that. And as you can see the relationship here, as you have a longer term loan payback or amortization schedule, this ultimately increases the amount of interest that you pay, which then means you have a higher amount total that you're paying in terms of interest tacked on to the loan. So in the 15-year example here, it's approximately 52%. In the 20-year example, it's approximately 72%. And then the 30-year example, it's 116%. So you can see it gradually increases and goes up quite a bit from the 15 to 20 to 30-year scenarios. And you're paying quite a bit more in interest as you get out to the 30-year. It's not as big of a jump from 15 to 20, but from 20 to 30, it's a huge jump, and you're ultimately paying about 116% percentage extra paid. So another thing worth noting here, this is the total principal paid over a 10-year period. You can see how that's calculated if you'd like to pause the video. We also have the interest paid over a 10-year period cumulatively. You can also pause the video on that as well. So let's just kind of focus on this data. So basically, the total amount of principal paid for a 15-year mortgage in this assumption scenario is $211,000. In the 20-year example, it's $133,000. And then in the 30-year example, it's $61,000 approximately. And the amount of interest for the 15-year mortgage is $168,000 over a 10-year period. For a 20-year mortgage during that same 10-year period, it's $189,000. And then for the 30-year mortgage, it's about $208,000 paid in interest. So this just gives you a quick breakdown comparing these loans to each other. Ultimately, one thing worth noting, I think I touched on this earlier, but basically you're going to have a higher payment when you have a shorter term loan or shorter amortization. So basically the loan needs to be paid back quicker. But then with that, you're paying less interest through the life of the loan, but your payment's higher. So we'll have subsequent videos talking about, okay, now that we know the differences between these three loans, when we have these differences in payments and see what our affordability is, does it make sense to do a 30 when you can have the difference be invested? What does that look like? That's some stuff we'll touch on in subsequent videos, but I really just want to give you a breakdown in terms of the difference between a 15-year, 20-year, and 30-year mortgage, what percentages in this assumption scenario are for your extra paid, and just kind of what the payment differences also look like. So you can kind of get a flavor, obviously, if you change the rate and some of the assumptions from that standpoint, your percentage extra paid will change. But relative to the 15, 20, and 30 year, the relationships are going to be there in terms of the extra percentage paid is lower in the 15-year example. So hopefully today's video was informative. Be on the lookout for future videos where we do discuss how savings in your mortgage or on a monthly basis can be invested, and modeling that out in terms of, is it better to take a 30-year mortgage because I'm going to pocket that money and invest it in something such as a stock market or a real estate investment elsewhere? What does that look like? So we'll go over that in later videos. Again, this continues part of the Compounding Life series on personal finance, investing, and time value of money. Thank you very much for watching, and have a great day.